What is the Single Resolution Mechanism, or SRM? The Single Resolution Mechanism is one of the pillars of the banking union, which was created as a response to the 2008 financial crisis. It covers the banks supervised by the Single Supervisory Mechanism as well as a number of cross-border banks. The SRM is composed of the Single Resolution Board and the National Resolution Authorities of participating member states. Its mission is to ensure an orderly resolution of failing banks and banking groups, with minimum impact on the taxpayer and on public finances of the participating member states of the banking union. How does the SRM work? Usually, the European Central Bank, ECB, after consulting the Single Resolution Board, SRB, determines whether a bank is failing or likely to fail. If a private solution is possible, that will be the preferred option. Next, the SRB verifies that there is no reasonable prospect that alternative measures, such as investments from the private sector, would prevent the failure of the institution within a reasonable time frame. Finally, it is determined whether a resolution of the bank is in the public interest. If it is not, the bank will be wound up, in the same way any normal business would be. However, if the first two conditions are met and a resolution of the bank is in the public interest, the SRB places the bank under resolution. When developing the resolution scheme, the SRB identifies the resolution tool to be used and determines whether or not to use the Single Resolution Fund, SRF, which is financed by the banking sector itself. The European Commission and, in certain circumstances, the EU Council are involved in the approval of the resolution scheme, which happens within 24 hours of a bank being declared failing or likely to fail. After it is approved, the relevant National Resolution Authority will implement the resolution scheme.